Hi everyone, welcome to my YouTube channel. My name is Tabitha and today we're going to talk about bonds or stocks. So which of these securities will you want to put your money in and why? And before we get to choosing which one do you want to put your money in, we will look at the differences and why other investors will choose stocks over bonds. So we are looking at the bonds or stocks today. And we are going to look at the differences and see which one really suits your investing style. So if you're new to this channel, please subscribe for more videos and I will appreciate your support. So the agendas of today, they're all going to come out of this book called The Single Best Investment. This is the book of the year. So sometimes I'm busy doing other things, so I don't really read many books. Like maybe I want to read 10 books in this year. So I only do one book. And as long as I get the value out of it, and then it's really good. So I'm reading this book and I'm drawing some lessons from it, and we are going to discuss them together and see which one worked for you. So the agendas of today will be like few of them. So first of all, we need to understand what is bonds. And the second one would be the stocks for people who are not familiar with that word, stocks. And then again, we will look at the differences between the bonds and the stocks. And we check the recommendation. What does the author say or recommend? And what does other investors think is the best way? And which one will you want to choose based on that information and also your own judgment as an investor? So let's see. First of all is what is bonds? So bonds, some people will only understand, we have government bonds, we have companies bond, and all these things. But what are these things? So it's just like loans from investors to company, to government, to individual. Some individual investors also buy bonds from the government too. And the contract is always like some maturity date. So you can hold it, get interest on it, and then when it matures, the company or the government or individual that give you that loan is a loan that make you interest. So you buy that loan called bonds, and then it make you interest because it's like in the exchange of cash. So the money is taken by the company for them to do whatever they want to do with it. The government do whatever they want to do with your money, but you're holding on to this bond, and this bond is like loans. It's a loan that's been given to you by the government or the company or individual or investors that gave it to you. So you hand your interest up to some point, and then that point you are given back your principal, and you had already been earning regular interest. So that's the bond. Other people really argue that this were more safe than the stocks, and your principal is guaranteed even if you make small interest on it. But what are the stocks, and do people really misunderstand the stock market, or is it going to work for everybody, or some people are not going to see it as it is for them, it's meant for them? So stocks are ownership shares in a company. So there are some certificates that the company creates to sell their membership, to sell their shares. So those certificate has monetary value. So you buy them. So let's say the company TD is issuing shares of 10 million. So if you buy 10 of those, you own 10% of the TD shares. If you buy 20 of those, you own 20% of the TD shares. So it's a form of equity. So you give them your money, you hold on to this certificate. So this certificate has monetary value. So if that monetary value of that certificate increase, and then you can sell it and give the ownership to somebody else, and you get the money. So that's how it works. So people buy it low and they sell it high. So another person will take the ownership of that stocks, and then they will go and take it to another person, take it back to the company, and then that's how it goes. Our ownership shares in a company stocks. So now let's look at the differences between the bonds and stocks. So why do people say they are different? They are different, and people prefer one over the other. So for people who are more conservative, they will not want to be invested in stocks because they think stocks are high risk. But stocks also they have higher rate. So the higher the risk, the higher the return. So on this side is like they are lower return, but lower risk. So the lower risk, the lower return. So you just weigh which one would you really want to invest in. Is there any disadvantage that will make you go that the bonds have that you will make you prefer taking that higher risk? Do we have anything of loss? So in this case, we also have the stocks are higher fluctuation. So if you're someone who is not familiar with the fluctuation of the market, it can really give you time to worry. You worry about losing your money. You worry about, okay, what if I keep and it's now it keep going down. So should I sell it now or should I wait? All those stuff. So those risky high fluctuations come with the stocks. On the other hand, we have bonds, lower fluctuations. So it doesn't really fluctuate that much. The interest that you pay every month, it doesn't really fluctuate that much. Stocks, no collateral. Bonds, they have collateral because most bonds are loans, so they have to have some sort of collateral. Sales higher than bought. So you buy it at the lower price and then you sell it when the price goes up. This one only pay, the bonds only pay regular interest. So you agree like this bond has 2% and this is the 2% that you will be getting every month. Stock price rise. When the stock price rise, the bond price fall. So they operate in an inverse kind of manner. So when the stock price rise, the bond price fall. And the reason is when the stock price rise, it attract the amateurs, those people who time the market and they think now, okay, now the price is going up, let me go and buy stocks. And what they don't really understand is that sometimes some stocks are at the peak and they're about to reverse. So when they buy it at a higher price, and then the stock reverse, and they end up like being in the red. They're being in the red. And if someone was not prepared for fluctuation, higher fluctuation, those people will sell the stocks at the rate season, and then they will lose their money. On the other hand, why the bonds price fall when the price of the stock goes up is because majority of people now want to buy stocks because they think they are rising. So bond become less demand than the stocks. When the stock price fall, people fear. They say, oh, everything is going down, everything is going red. These are people who time the market. They don't know how to benefit when the stock price also go down. So these people will go and demand bonds. They will see bond as more attractive. So at that point, when the stock price goes down, the bond price goes up, right? Because there's more demand on that side, and that will push up the bond price. The capital gain tax. So stocks get capital gain tax. Bonds get income tax. So those are the differences between the stocks and the bonds. So if you know any other differences that was not mentioned in this video, you can add it in the comment section and I will appreciate your input. The next things will be like, what are some of the recommendations that we will withdraw from knowing the definition of stock and the definition of the bonds and the differences that exist between the two. So if we come to that point, we will look at the author of the book and what do he recommend, or which path does he choose when it comes to the differences between the bonds and the stocks. And for the author, he recommend that you buy only stocks. If you want to diversify by adding dividend stocks. So dividend stocks are companies that are well established. They are blue chip companies. They pay dividend every month, but the fluctuation is not that rigorous. So it's not that high. They don't have that high fluctuation. The growth is also low, but they can pay dividends. So if you don't want to be all in the fluctuation, in the risky situation, you can diversify your portfolio by buying some dividend stocks. Learn how to take volatility for the long-term gain. So that his advice. So if you have to avoid bonds and you buy stocks and you only buy stocks, make sure you diversified it by adding dividend stock, which are blue chips stocks, and then also learn how to take volatility. If the price is moving up and down, what is your goal and why do you think that stock is safe to hold? Recommendation, we are on most of recommendation. So other investors, the way they think, some other investors say you don't have to remove bond altogether. Like they think like there's a benefit when you have the mix of the stock market and the bond market. So when you have that one, it will help you to diversify and you will benefit for both. So these investors, they advise that if investors have to choose both bond and stocks, and then they have to really lay it out that 70% goes to the stocks and 30% goes to the bond. If you're older investor who is approaching retirement and yours, you will measure it by 40% stocks and 60% bonds. That is more diversified and it will help them to benefit from both market. Investors could benefit from a mix of both, and that's what we're doing here. But the author suggests that only do stocks and diversify it by adding stable companies that pay dividend. For more recommendation from the book and from other investors in comparison of whether you should buy stocks or bonds. Author. So what did the author say that you can do? Or what is his argument of just choosing stocks and not the bonds? So according to this author, he said that bonds they grow in the environment that is not conducive, which is the inflation environment. So if you buy bonds and the rate that the company give you is not higher than the inflation, and then you're losing, you're the loser in the end of the day. So he recommend that you have to understand the environment in which all investors live or your investment live. Inflation is about investment. It's about environment. Like bond will definitely suffer inflation risk unless if the company has given you the rate that is higher than the inflation. So if you're going out there and you're telling someone to help you do your investment, so you can ask what is the rate that they have on your money, the rate that they are giving you. What is the rate? The investor psychology, how do other investors think and how do they decide? What influence their decision? All those things comprise into what really direct the market, whether it's down or up. So for him, take care of the inflation. If you have to buy bonds, you have to ask the company that is giving you bonds whether they're giving you the rate that is above inflation. Otherwise, inflation is going to eat your money. Another recommendation from this book or from the outside research is that inflation. So when we look at the inflation, is more when the prices rises every year. Prices are rising every year, and the value of your original investment decline. So this is how you're affected. If you have invest your money, you have invest your money in the bonds, and they give you lower rate than the inflation. Over the years, the prices will keep going up, and the value of your original investment is going to decline, which means your purchasing power is going to go down. Get returns that are above inflation. You need to count for increasing costs. You have to count for that. Otherwise, you investing in safe investment that will lose in the end. The value is not going to be the same, and then it's not really worth it. So you have to fight if you have to invest in bonds. Another recommendation are so the author says why fixed income investors lose in the end because of inflation so far, right? Because those T-bills, bonds, and all those stuff, they lose in the end because of inflation. Even GICs too. The GICs depend on what rate do you get for your investment. So if your rate is lower than the inflation, and then you're going to lose in the end. So some companies, some banks, they don't no longer have the T-bill. So some is just mostly GICs and bonds. So check what you are investing in and what rate of return are you getting, and compare that rate of return with your inflation thing. So purchasing power and the real value decline, right? If inflation is at war with you, your money purchasing power is going to go down. The real value of your investment is going to go down. Each year, inflation takes its silent bite, and by the end of the period, you can only buy a fraction of goods and services you could afford previously. So now let's look at more recommendation, and we will wind up and see. You can watch this video and see by yourself which security do you want to invest in. Is it stocks or is it bond, and why? What is your risk tolerance? Fixed income versus stocks. So stocks have higher growth than the bonds, but the higher growth come with more risk. And then a fixed income like bonds, they come with the lower return, lower risk. And in the end, they also suffer inflation risk. So historically, it has been shown that stocks are far superior to fixed income. And that's why some people will prefer to invest in stocks, because they can grow over time. If you actually know how to manage your portfolio, you will keep growing over time. So that's the end of the video. And if you like what we just presented today, subscribe for more videos, and we appreciate your